Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you some money. My job is not just to teach and entertain, but to do some education. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. We keep wondering, what would it take to make people start focusing on all the other stocks in what I call the real economy instead of just the speculative stocks in the AI data center stocks? Well, today we found out you need to see a big tech company screw up and then get slaughtered. I'm talking about right through the meat grinder. I'm talking about just annihilated. I'm talking about Meta. And that's when people start to care about the hundreds of stocks that are part of the real economy again. Although you might not have noticed from the action today with the Dow dipping 110 points, S&P tumbling 0.99%, NASDAQ plunged 1.58%. Yet last night, Meta Platforms reported what I thought was an amazing set of numbers. Beautiful in every way. Great user growth, incredible profitability, good margins. So far, so great. But the company had to take this big charge no one saw coming. Don't worry, non-cash, still plug ugly. More important, management committed to a level of capital spending that far outstripped what anyone saw coming to an amount that, frankly, seemed imprudent, if not downright reckless, to many of the big hedge fund managers who determine your stock prices. The result, Meta stock did indeed get eviscerated, plummeting more than 11% today, which is why the S&P and the NASDAQ got hit so much harder than the Dow Jones Industrial Average, as the Dow's got a lot less tech. To many of these big-time tech players, not me, but them, Mark Zuckerberg has lost his mind, or at least all his discipline that he had demonstrated so well during that year of efficiency. To them, he's now in the year of living dangerously. I know this seems like circular reasoning, but there's another reason the S&P and especially the Dow held up so much better than the NASDAQ. Whenever investors start fleeing from tech, something they do very rarely, I know, they swap into industrials or the financials or even the healthcare stocks, including ones that reported bad numbers. Their stocks were surprisingly buoyant today. Now, some of these moves have a lot to do with people hoping that yesterday's quarter-point Fed rate cut would actually do something to help the broader economy, which we know is sluggish, including housing, which is how Home Depot still managed to rally. And by the way, that's my go-to stock today, for both the store and for home improvement. I always like to have a couple of stocks that I follow very closely to be sure that I am right about the market. Or how about the drug companies? Holy cow, remember them? They used to be big and important, weren't they? Eli Lilly reported this morning, and their GLP-1 complex, the weight loss, diabetes thing, made $1 billion more than Wall Street expected. That's tech-like. When I first saw it, I was thinking, okay, the market won't care. Big yawner. We own Lilly for the trust. We believe in it, but we feel like we're dopes lately. But you know what? I knew that Dave Ricks, the CEO, was going to be on Squawk on the Street. I said, hey, listen, maybe something good will happen here. Maybe I'm too jaded, right? I just assume nobody will care because it's pharma, a group that nobody seems to want in this environment. Apparently, I was wrong. That's right. Eli Lilly's stock rallied nearly 4% today. I think we have Meta's weakness to thank for that gain. Mark Zuckerberg, Dave Ricks, go thank Mark Zuckerberg. All right, that's right. Wall Street was horrified by what they saw from Meta's incredibly profligate spending, in their view, on all the hardware that goes in the data center. So shocked that it made people sour on the entire group for at least 24 hours. By the way, when Meta spends that money, you better believe that a ton of it goes to NVIDIA. So talk about guilt by association. If Meta stock is going to get punished for spending money at NVIDIA, then a lot of money managers will assume it's time to sell NVIDIA, the $5 trillion monster. I disagree, and do I worry about what the president's going to do with China and NVIDIA? Of course. Hey, if you're an NVIDIA-holic, as I am, you bet I'm worried. But when I see the reaction to Meta and the pin action that rippled through, that is far more disconcerting. Is it time to give up tech, you might be asking? No, not at all. It doesn't work like that. Money can flow right back in easily, and I think that actually is probably what's going to happen tomorrow because of some astounding developments that happened after the close of the market. That's right. We got some miracles tonight, 2 of them. We got not just 1, but 2 huge upside surprises in both the future and the quarters. And I'm talking about Amazon and Apple. Amazon reported a hefty top and bottom line beat, crushing expectations. But much more important, this Amazon Web Services, AWS, regarded currently as its most important division and also its Achilles heel, saw its revenue growth accelerate from 17.5% to 20.2%, with higher than expected margins, too. Remember, coming to the quarter, I told you that Wall Street was focused like a laser on the growth rate for web services. I think that's a little myopic, if not downright stupid, but it's what the shareholder base care about. And Amazon, well, it blew away all expectations. As CEO Andy Jassy put it, quote, AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20.2%. Yeah. We continue to see strong demand in AI and core infrastructure, and we've been focused on accelerating capacity, adding more than 3.8 gigawatts in the past 12 months, end quote. So far, so good. On top of that, management gave strong guidance for the current quarter. Hey, maybe Meta's spending like a drunken sailor, but Amazon's doing just fine and efficiently putting up great numbers in the process. It's great to be prudent sometimes. This was some darn quarter. And look, am I doing cartwheels about it? Yeah, kind of. All right, how about Apple? I think they reported a pretty darn good quarter with record revenue for the period of time, up 8% year over year, slightly above expectations, along with an 8-cent earnings beat off a $1.77 basis. Apple posted record great service revenue, up 15% year over year. But you know what? Nobody cares about that. You see, that's not the way it works. See, that's what's called the past. And the past, well, people say, oh, the stock's up a lot. So the stock started falling. It was like step by step, inch by inch. You could see the stock slowly fall. And then what happens? They put out the guidance. And the guidance, well, you had China sales light when the quarter came out. You had iPhone sales short when the quarter came out. But when I say that guidance, I always say you to own Apple, don't trade it, and to certainly don't trade it until you hear what they say on the conference call. And, oh, boy, CEO Tim Cook told an excellent story, calling out strength across almost all the company's products and services, giving very strong guidance for the current quarter. I mean, like, I'm talking ramp. And on the call, it became clear that the iPhone 17, hey, who told you it was good? Thank you. I like to kiss myself periodically. Has been a smashing success. Coming into tonight, Wall Street was expecting 6% overall growth for Apple in the current quarter, roughly 6% growth for the iPhone specifically. But tonight they said it's going to be 10 to 12% revenue growth. And the iPhone will be up double digits, too. At the same time, Cook told me tonight that he expects China to return to growth this quarter. As an Apple acolyte, I couldn't believe this. Suddenly, the two biggest pain points
the House of Pain
become House of Pleasure.
Because the quarter was just that good and the guidance was much better, which is why ultimately Apple got a nice pop in after-hours trading. I expect more. And by the way, can I just explain to you this? It looks like my anger about the right to own Amazon earlier this week and my multi-year admonition to own Apple, don't trade it, paid off again. And what's really important for you to know, everyone thought Apple stock looked expensive, but when you saw the future, you realized, hey, maybe it wasn't that expensive after all, the bottom line. Today, people focus on the real economy, and again, as Meta stock got obliterated. But after these two terrific, after Apple's good quarter and fabulous guidance, and Amazon's great quarter and great guidance, I wouldn't be surprised if the money comes right back into tech. Yeah, tech will be back in the saddle tomorrow. But wasn't it great to have a day when the real economy did okay? Let's go to Carl in Illinois, please. Carl.
Hey, Jim, calling from the cab of a John Deere. How are you doing today?
I am doing well, and I like Deere. I think it goes to 600. I like the soybean order from the Chinese, too. Obviously, it was very good. I like the soybean order. Take that down.
Yeah.
Okay.
I'm curious for your take on Goodyear Tire and Rubber.
No. No. I mean, let's stick with Deere. No, I mean, look, that's just a really hard business. It doesn't even seem to matter who runs it. I haven't liked the stock since 1984. I'm not going to deviate. Come on, I'm on a roll here. My executive producer just pulled the plug on this segment. Says it's time for a commercial. Do you know how fired up I was? Do you know how right I was? Okay, I'm sorry. That was bad. I didn't mean to say that. I've been wrong on some. Hey, it's a nice night. People turn their attention to. I care. People turn their attention to stocks died in the real economy today, but I wouldn't be surprised if tech retakes the reins tomorrow after these blowout quarters from Apple and Amazon predicted in this. Thank heavens, it could look bad for years. On Mad Money tonight, once a market darling, Reddit has spent the past month in the doghouse. So was tonight's report the catalyst that the stock needs to be get going again? Don't miss my earnings exclusive with the CEO. Then is the Shack back? I'm digging into Shake Shack's story with the company's top brass and seems it's time to start nibbling at the stock again, if not the fries. And Logitech found itself in the tariff crosshairs. So how is the company doing to pursue what looks like to be an all-time high? I'm sitting down with the CEO and getting the latest. So stay with Cramer.
Don't miss miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.